Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Southern Copper stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Southern Copper is a mining company founded in 1952. 89% of the company is owned by Mexican mining conglomerate Grupo Mexico. Southern Copper is the world's largest publicly traded copper mining company and the world's 7th largest copper mining company. Also, the firm is the 8th largest copper smelting company. Southern Copper ranks among the world's largest producers of silver and zinc. Let's get started with the model. This is a large cap company, 46 billion market cap. They're trading at $60 a share, and they have 773 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has growing and positive free cash flow each year. Net income is the profit and loss on the income statement. That's revenue minus expenses. And they also have positive and healthy net income each year. Their revenue grows a little bit each year. It goes from 6.7 billion to 7.5 billion. This is the company's income statement. The top line is the revenue, the sales for the company. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. That was 4.6 billion. And their gross profit was 2.9 billion, which was a little lower than 2019 and a bit lower than 2018. Their operating expenses are pretty low, only 166 million. So they have 2.7 billion of operating income, which is pretty consistent each year. So below operating income is the interest they pay in their debt minus the interest they receive from their investments. So it's pretty small relative to their operating income. And they have $50 million in other. Other income and expenses are usually gains and losses from investments or acquisitions. And the bottom line of the income statement is the net income, and they had 1.3 billion in the trailing 12 months. This is the company's revenue broken up by metals. There's copper, which is the bulk of its revenue. Then in second is molybdenum, then zinc, then silver, then other. So copper has been increasing each year from 5.5 billion to 5.7 billion to 5.8 billion. Zinc is the only metal that decreased. It was 326 million in 2017 and then dropped to 278 million in 2019. This is the statement of cash flows. The way you calculate free cash flow, it's operating cash flow minus capex, and that was positive each year, and it seems to be growing. So it appears the company didn't take on any new equity in the past 4 years, but it looks like in 2019 they issued $1 billion of debt. So whenever I value or invest in a company, I like to look at the operating cash flow, because the purpose of any business is to generate revenue and profit by supplying a product or service. And operating cash flow is the actual cash that went in and out of the business. The reason the income statement can be difficult to look at is because there's a lot of non-cash items, so there's tricky accounting things going on. So their net income was $1.3 billion. And to calculate operating cash flow, we have to first add back the non-cash items from the income statement. The company reported a $760,000 depreciation expense, so that brought down their net income by that dollar amount. But that's a non-cash item. They didn't actually pay $766,000. We have to add this amount back to the operating cash flow section. Also on the income statement was $104 million of deferred taxes, so we have to minus it from the operating cash flow section. And there's also changes in working capital. So it looks like the company had a positive $144 million of inventory. That means they took $144 million of inventory off their balance sheet and booked it onto the income statement. So the cash the company generated from its operational business was $2.2 billion. This is a good sign because that means the company could run its business just using its operating cash flow and not funding the business on debt and equity. Let's look at a capital structure. $6.9 billion of equity, $8 billion of debt, and $6 billion of net debt. Net debt is debt minus cash. They pay 4.7% interest on their debt, and cost of debt is 2.85%. The way you calculate cost of debt is interest rate times 1 minus the effective tax rate. And 54% of the capital structure is debt. That means 46% is equity. Cost of equity is 11.15%. And to calculate cost of equity, we need the beta. That's how volatile the stock is. The higher the beta, the higher the cost of equity. and their beta is 1.15, so the stock moves a little more than the market, and their WACC is 6.69%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $37 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $35 billion. We divide that by 773 million shares. And we get a calculated stock price of $46. They're trading at $60, so they're trading at a 31% premium. It's a sell according to the model. Simply Wall Street is a little higher than me. They're at $50 a share, so they're saying the stock is also overvalued. This is where the stock has been trading the past 5 years. So you can see the stock is pretty much trading at its all-time high. The stock price has really been driven up the past few months. The stock price increased 45% in the past 52 weeks, which is much better than S&P of 15%. Its 52-week high is $61, and its 52-week low is $23, and it's trading almost at its 52-week high. Of the 773 million shares outstanding, only 84 million are available to the public. So the company's float is about 11 or 12%. The lower the float, the more volatile the stock is. The reason for the low float is because Grupo Mexico owns 89% of the company's stock. The company pays a decent dividend, 3.35%, and their payout ratio is 90%. The way you calculate payout ratio, it's annual dividend payments over net income. So they're paying almost all their net income out as dividends. If you invested $10,000 into this company 10 years ago and you reinvested the dividends, you'd have $18,300 today. If you did not reinvest the dividends, you'd have $15,500 today. Here's a better look of their mines, smelting facilities, and refineries. The triangles are mines, and the diamonds are smelters and refineries. Copper is used in every major EV component, from the motor to the inverter to electrical wiring. And an EV car can use up to 1 mile of copper wiring. And I know EV cars are getting more and more popular. I even grew the company's future free cash flows 30% more than my model calculated. EV cars also use quite a bit of silver. The engine for an EV car uses a lot more silver than a traditional car. The engine, battery pack, and battery management system all require silver. In 2008, the company's board of directors authorized a $3 billion share repurchase program. From 2008 to 2016, the company purchased $2.9 billion of its stock. When a company buys its common stock, those shares are taken off the market and put onto the company's balance sheet as treasury stock. This benefits you, the investor, because there's less shares in the market, and this gives you a more proportional share of the company. There are pretty much 2 ways to reward investors: pay dividends or buy back stock. Buying back stock does help you, the investor, but you don't want the company to buy back stock when the price is really high because they're wasting money. You want them to buy back stock when it's low. So the reason there's such a low float is because Grupo Mexico owns 88.9% of the company. Then the next is BlackRock, which is under 1%, T. Rowe Price, Fisher Investments, State Street, Goldman, and Arrow Street. The average age of the leadership team is 60.5 years, and the average tenure is 7.5 years. The president has been with the company for 16 years, and the compensation package is $1.6 million. When I invest in a company, it makes me feel good when the management is there for a long time. Let's look at the financial ratios. The average PE in the market is 12.6, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 35.9. That means investors are paying $35.90 for $1 of earnings, which is worse than the median and average. Price of sales is stock price over sales per share. They're at 7.2, so they're a little better than the average. Price to book is stock price over book value per share. They're at 6.7, so they're worse than the median and average. The way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet. And their tangible equity is $6.7 billion, so they have a little bit of tangible assets. And I found this in the 10K. Their tangible assets of $121 million of mining concessions, $19 million of mine engineering and development studies, and $56 million of software. And these assets get amortized each year. So this is the amortization, plus they have $42 million of goodwill. Interest coverage ratio is EBIT over interest expense, so they can cover their interest payment more than 7 times, which is great. ROE is net income over equity, and they have a solid 19%, much better than the median and average. Current ratios, current assets over current liabilities, are at 2.8, so they can easily cover their current liabilities. Their current assets are $2 billion of cash, $900 million of receivables, and $1 billion of inventory. And their free cash flow was $1.7 billion. Their working capital is $2.7 billion, so they're well capitalized. Working capital is current assets minus current liabilities. And the best way to look at ratios to compare them to similar companies, I've done videos on Arrow Copper, Freeport-McMoRan, First Quantum, London Mining, and Southern Copper is right here. And if Southern has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE because they have positive earnings. A couple of these companies have negative earnings. Price to sales and price to book are a little worse than average. Current ratio is higher than average. ROE is higher than average. Their debt is 54%, average is 41%, and their market cap is the biggest of all the companies by far. And their dividend is higher than average at 3.35%. To summarize, I have them trading at a 31% premium because their stock price has come up so much in the past few months. That doesn't mean it can't go higher, because the stock price is based off of supply and demand of the market, not necessarily what a company is worth. But their financials and ratios look really good. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.